Possible 211 in progress at the Valley Trust Bank, Boyle and Kittredge. We have shots fired.
Ordnance officer needs assistance. Boyle north of Valley Trust Bank. Shots have been fired.
We're going to need some type of heavy-duty vehicle to do this because we are all slowed down by automatic gunfire.
16 10 advised, and you need some type of heavy-duty machinery to get the officer up.
Hello folks. Alright, we are going to cover the need for a trading plan. If you're new to trading and you do not have a trading plan, it's hopefully my goal as an end result in this presentation to communicate the need for one. If you already started trading and you've been having difficulties and you don't have a trading plan, I could pretty much guarantee if you just put some work into formulating a very clear, concise trading plan, your results would be dramatically different. Because basically having no plan equals emotional driven results. Okay, you're not going to have any understanding what to do. You're going to be reacting more than you are anticipating. And that's the stark difference between a professional trader, because they do have a detailed, organized trading plan. It's well written. It's by their trading desk. It's memorized. It's reviewed continuously. And by having such, they have an objective end result. And it really is the DNA of a successful trader. So having a trading plan is at the top of your list as far as being a consistently profitable trader. All right, the majority of your time, what do you do as a trader, and where is it most spent in terms of time? Well, first you got to understand that you have to manage your time wisely. Okay, no one's going to manage it for you. So it's important that you understand that the countless hours that you spend in analysis without having a clear objective or premise to it is actually counterproductive. Okay, you feel like you're doing the right thing by spending a lot of time staring at the chart, but unless you have an understanding of exactly what it is you're looking for, you're just wasting your time. You need to spend quality time with the macroeconomic analysis and higher time frame support and resistance levels. I can't stress this enough because most new traders come into the marketplace and they spend too far time in the 5 and 15-minute charts and maybe even 1-minute charts, hoping to see some kind of mysterious neon sign saying buy me or sell me. Nothing significant occurs without first leaving telltale signs on a long-term basis. That means if there's a significant price move, I guarantee you, if you look at the higher time frame charts, and I'm referring to the monthly, weekly, daily, 4-hour, and no less than a 1-hour chart, those time frames are going to have a clue as to what was the catalyst for that move prior to it actually unfolding. Follow the interest rates. This is where the majority of your time is going to be spent. You need to get a feel for what interest rates are trying to do. Are they moving higher? Are they moving lower? Keeping track of the overnight lending rate with the banks per country is absolutely significant information and insight you need as a consistent trader. Okay, what's the least important process in trading? Well, don't focus on the money, number one. And unfortunately, we all get into this business for a number of things, okay, but the top of the list should be to make money. But while you're trading, your focus should not be on the money. Don't focus on the amount of money that you hope to make. There's no guarantee you're going to make it on every trade, so there's no real point in hoping. You just trade the process, trade your plan, and the end result should, if you have a well-grounded, well-formulated trading plan, money will deposit into your account. Do not worry about losses. Okay, you're going to have losing trades. If you accept that going in, you won't be demoralized from it. Okay, every good trader, whether they're professional or not, they have losing streaks. Do not worry about missed trades. I'm going to tell you right now, I probably miss more winning trades every single week than more than most of you realize. I don't take a whole lot of trades. I like to cherry pick. I like to take things that are really set up. And if you have that mindset going in, much like expecting losses, it's very comforting to know that you're not feeling rushed. And that's a very important characteristic of a professional trader. We aren't rushed to get in the marketplace. You know, we react slowly when trying to make money, and we react fast and quickly when we're trying to preserve our money. That's a very significant paradigm shift that you're going to need if you don't already have that mindset going in. The least important process in trading is the entry signals, and I know that probably shocked you right there, but it really is least in terms of significance. If you don't have a macro understanding of what's going on in the marketplace and the higher time frame directional bias, chances are you're probably going to be wrong more times than you're right. So it's my goal to really try to drive you to looking at the weekly, the monthly, the daily, and the 4-hour charts. And if you're going to go a little less than 4 hour, don't go below 1 hour. But spend most of your time on the weekly and daily. Those charts are going to be the most in significance because that's where the banking levels are determined. Premise and sound basis is paramount. That means you have to have an understanding of what it is that you're doing. You're not just staring blindly at charts because that's not going to get you anywhere. I guarantee you, unless you have a specific pattern, a motive that you use to get into a particular trade, and you hunt that, whether you're back testing or walking forward with it, unless you have that understanding of what it is specifically that you're looking for, you're just basically spinning your wheels, and it's my advice not to do that. Keep the focus on the plan and work the trading edge that your method exploits. Alright, the general overview. Alright, trading plans are basically taking all the pieces of the puzzle that equate to successful trading and bringing those pieces together. Those pieces could be fundamental data, technicals, intermarket analysis. All these things go together in terms of building a trading plan. Impeccable risk control is the first component to any successful trading plan. Flawless equity management, which is closely tied to risk control, is essential to every successful trading plan. You can have all the bells and whistles on your trade monitor, but it means nothing unless you control your money and the risk involved in all your trades. Fundamentals at any measure can always assist a trader in trade plan development. Intermarket analysis is key to a well-balanced trading plan. Understanding how all the asset classes tie together and hinge upon the movement of the interest rate markets, that is crucial for your long-term success and longevity in trading. Technical analysis and a comprehensive approach to sound tools and concepts is the framework to exercising a trading plan. If you don't have a concise list of specific tools that you use for specific times and reasons, you're going to be floating in and out with different oscillators. You're going to be using different tools. Understand what tools you're going to have and stick to those, and understand what it is that those specific tools do, and try not to use them for any other reason except for those purposes only. Executing a top-down analysis with all the above components will deliver optimal results while controlling risk, which is the #1 reason why we as traders last as long as we do in this business. We control risk. So all the pieces together, it begins and ends with the control of risk. The paradigm shift. Alright guys, you are not the only predator in the marketplace. I know sometimes when we get these trading plans and trading tools, and this is the first time you've ever probably looked at organized structure of how to apply analysis to the marketplace, and you feel kind of like a big shot. And that's normal, that's kind of cool, I know. But do not overestimate the importance of knowing there's other people out there that want your money too. Whether you go in confident or you develop confidence later on, understand overconfidence is actually counterproductive. Overconfidence is actually an invitation for ego, which also allows the input of emotions, and that's not what you want in your trading. Never assume your well-designed trading plan won't hit a losing streak. I'm assuring you that it will. There's no one out there that is immune to it. You're going to have a losing streak, okay? Always reflect on your wins as a victory and your losses as a learning opportunity. All the learning opportunities that I've experienced in my trading have actually produced greater growth in my development as a trader. So losses are actually a beneficial thing. It will take preparation in advance to weather periods of inevitable drawdown. Journal your results, both good and bad. It's important that you go back to that journal because in periods of drawdown and strings of losses, it will help remind you that these are temporary events and that you do eventually trade out of them if you control risk and reduce the overall exposure as you continue to take losses. Do not overdrive your trading plan or attempt to trade outside its intended purpose. Do not turn a position trade, okay, into multiple different time frame trades. Okay, if your analysis suggests it's a position trade, trade it like that. Okay. Every great trader has one thing in common, and it's the respect and understanding that the risk will always outweigh the reward unless it is properly managed. It's not about the profits. It's controlling risk. Pack small, play big. 2% risk or less. Is it really enough? I probably get this question emailed to me more than any other. When you get into trading, guys, you probably fantasize about going to places like this, and you think you need to risk 20, 15, 10% of your account to get there. And I can assure you, I've been to places like this, and I've done it with 2% risk or many times with less than that. And it's amazing if you just understand the power of compound interest. You don't need a whole lot of risk exposure to build this wealth. The question will always be in the developing trader's mind, how can I make a fortune with so little risk? And hopefully by the end of this presentation, you'll see that you don't really need a whole lot of risk. You just need time and consistency. Proficient, consistent traders focus on the reality that their trading will not be perfect. We are not going in with the mindset expecting our trades to be perfect. Okay? We don't even need high accuracy. Okay? But you do need consistently following a trading plan. That's paramount. You have to continuously do that. You can make all the money you will ever need risking 2%, and many times even less than that per trade. Wealth is built with time, not excessive risk exposure. Keeping realistic goals in focus. Alright guys, you've seen all of the internet gurus, and you probably thought I was one like that as well, that promised riches real quick. You're going to get 1,000 pips every month. Guys, look, don't take the bait. Okay, that is meant for you to lose. Okay, do not buy into that mindset. Your goal is to steadily build your account with little drawdown as humanly possible. Your trading is not hinged on the premise you must hit home run profits every trade or even weekly. There's a lot of times I'll have a losing week. There's many times I'll have a losing day and then come back from that and be able to recoup it. But I'm not always hitting win, 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 and you're not going to either. Your career should be built on a low yet sufficient baseline target based on percent return or pips per month or week. Trading with risk controlled and profiting a net gain of 25 pips per week should be a new trader's goal. After consistently harvesting 25 pips per week, graduate to targeting 50 pips. After 50 pips per week is achieved, aim for 75 pips, and eventually move beyond that as your experience and tolerance for risk increases. All right, let's look at a case study here. We're going to look at a trading model that more or less targets and shoots a goal for 25 pips for the week, and we're looking at possibly making 6% return for the month, and we're risking 2% per trade, and 30 pip stops are used, and the monthly goal only equates to 90 pips for the entire month. Now, if you look at these numbers, okay, this is a spreadsheet, so there's going to be a little bit of a rounding issue, but 23 pips, okay, per week, roughly, we'll just call it 25 pips. That would equate to 6% return per month. If you start with $2,500 in 1 year, your account goes to over $5,000, which is more than doubling. After 2 years, it goes to $10,122. Okay, so you can see essentially you're doubling your money every single year. You're only risking 2%, and you're only looking for 25 pips per week. Now notice over here we have daily column. Okay, this is more or less to stimulate the idea that if you trade on a daily basis and you scalp, I don't really teach traders to go in and try to scalp 5 pips, but just for the sake of argument, we're going to look at, every day if you scalped 5 pips, that would give you your 25 pips for the week. Obviously, if you're trading the best days of the week, which were Tuesday, Wednesday, and Thursday, regardless of what pair you trade, 8 pips per day, 3 times a week, would give you your goal for the week, and obviously 11 should be rounded up to like 12. Twice a week would give you your weekly pip haul. So you can see over time, your money is growing steadily, and while it's not a whole lot of money, you got to look at what you're starting with and what you're really aiming for. Okay, and I think 25 pips per week if you're a brand new trader is an absolutely wonderful goal to start with. Okay, look at another case study. This is 50 pips per week. Okay, and we're going to be targeting 10% per month, starting with the same account, $2,500. Now this time we're going to exercise the risk exposure of 1.5%. 30 pips per stop, and the monthly goal in terms of pips is 200 pips, and the weekly goal is 50 pips per week. And if you trade every day scalping, 10 pips per day equates to 50 pips. And 3 times, Tuesday, Wednesday, and Thursday, looking for 17 pips per day, or 2 times for the week at 25 pips per trade. The first year, your account would move to $7,846, and then in the second year, it would be at $24,624. Not bad, and you're not really hitting home runs yet, guys, are you? It's only 50 pips. Okay, look at a case study where we're looking for 75 pips per week. Now I can tell you, you can build a career on this. Okay, 75 pips is absolutely astonishing if you use it the right way. 10% per month, risking only 1% per trade, using a 30 pip stop loss. The goal, 300 pips. 75 pips per week. If you day trade every single day, 15 pips would be your goal. 25 if you're trading 3 times per week, and 38 pips twice a week would equate to your goal. And in 1 year, your $2,500 would essentially grow to $7,846, and again $24,624. Modular thinking, steady progress. Now, small consistency can still surprise you. It takes an exponential mindset. Little things over a period of time equals big results. Build in your trading plan flexibility. You're not always going to see it on the timeline that you want. You might have a weekly goal that may require shorter-term day trades or scalps to achieve. Do not force yourself into hunting or believing you need to make your goals daily and or weekly. Your weekly goals might fall short a week or two, but still might be met in the course of the same month. It may just average out, guys. Your monthly goal might average out over the quarter or over the entire year. Don't be so rigid and allow the market to pay you when and how it will. Your goals might fall short of your forecast and hopes. However, do not be disappointed if this occurs. You will still be heading in the right direction, and that's really what matters. Success without home runs. Is it possible? Well, let's look at this. This is kind of lofty, I admit, but this is what could happen. 20% per month. I know it's rather impressive. I know it's a number that many fantasize about. We're going to be risking 2% per trade maximum. And now we have an understanding of what we use in our trading plan, and we have some consistency. We understand how to use a lower time frame, so we can use now 20 pip stop losses. The monthly goal is 200 pips. Still, in terms of many expectations of traders, that's very, very modest. Weekly pip goal, 50 pips. And if you break that down, it could be done over a course of every day at 10 pips, 3 times a week at 17 pips, and 25 times 2 per week. $2,500 in 1 year grows to $22,290, and in 2 years it grows to $198,000, and in 34 months it grows to what everyone fantasizes about in trading, the $1 million mark. Keep something, pay yourself. You have to learn to be methodical about taking first profit, guys. No one's going to pay you. Your broker's not going to take first profit for you. They're not going to scale out some of your position and make sure you get some profit out of a winning trade. It's your responsibility. So before taking any trade, it's crucial for you to know at what level you will take first profit and then start to reduce or remove risk altogether. Limiting risk after taking half of your original position off will remove emotional and psychological pressures you may feel while the position is open. If you take first profit, that will absolutely remove all of the rush for you to be able to close the trade, because how many times have you been in a trade, even in a demo account if you guys are new, and you see a profit and you just want to close it out because you just want to see it in your account as registering as a profit? Okay. Well, when you take some off and you split your position in half, take some of it off, move your stop to break even, or reduce it to half of what your original profit was. That's a wonderful position to be in, because now, no matter what, you either make half of your first position's profit potential, in other words, first profit, or you stop out at even and you collect your first profit, and that was it. Taking first profit at a predetermined level will assist in building confidence and removes the sting of the trade losing should it reverse on you and stop you at a break even. How many times you had a winning trade and then go against you and now become a losing trade? Okay, I know what that's like. I'm not immune to that. I experienced that. The greatest thing you can do is learn to take profits. Take first profit and scale out. Continuing our theme, success without home runs. Now let's take a look at an example. Let's assume for a moment we are a trader that now uses 2 positions, okay, to enter on a trade. In other words, we take a maximum of 2% risk and we split it in half. The first portion of our trade, we take first profit at 30 pips. We're going to be risking 20 pips. So we're already risking 1.5 to 1 reward to risk. Okay, so we're making a little bit more than what we're risking for the initial first profit. And if we just did that alone in the second portion of our trade, we move to break even and it stops out every single time we trade for the entire year, our account would still double. Okay, risking 1%, it would equate to 6%. So that's still good. But now let's look what happens if we allow the second portion of our trade to run. What happens if the second portion captures the average daily range? Now the average daily range, for this sake of argument, we're just going to use is 100 pips. Now that would equate to, if you just did this once per week. Okay, now don't look at the daily, the 3 times per week or twice a week numbers. We'll block that out here. But the weekly number, that 100, that's going to more or less equate to one solid trade for the week where you nail down one average daily range or collect 100 pips, in other words, in terms of a intraday trade. That would equate to 20%. Now think, 20% plus 6%. What are you making? We'll get to that in a moment. But if we are able to do this, our money on 1% risk grows exponentially. Now, taking both of those examples together and assuming ideal scenarios at the end where both are profitable, that would equate to about 26% return. Your $2,500 would grow to $40,000 in 1 year and $640,000 in 2 years. Notice that you're really not even risking more than 320 average per pip. Alright guys, interest rates. That is the market's driving force, okay? If you never learned about interest rates, you're going to learn a little bit about it in this presentation. But what makes the markets go around, whether it be stocks, commodities, Forex, it's all interest rates. You need to get to know the interest rate market, okay? Because that will be the key to you unlocking the mine. The entire global markets are interconnected and they spin on the gyrations in the interest rate market. Each country we trade currencies with has their own interest rates, and thus these rates influence the demand or disenchantment with its own currency. The market will always seek yield, and the higher the yield, the bigger the demand on average. There are several types of interest rates that traders can track and utilize to determine a trade idea. Understanding how they trade and the yields will make long-term trends easier to determine. Interest rate spreads and differentials. Alright guys, you need to track the country's overnight lending rates. Okay, it's one of the core principles to having long-term trend analysis. And if you just Google any country and look for historical data, you can get that. Keep a spreadsheet, and you can do a whole lot with that information. It's not my goal to do that here. You can find sources on the internet to actually do these for you. But the currency markets, they more or less trend on long-term basis based on interest rates. And understanding which country has higher interest rates and which have lower rates can be a differential play or a carry trade. Now, not only can your trade profit by the directional bias that you're trading, but it also could be paid interest on top of that. If the country sees lower interest rates, this will weaken the base currency. On the contrary, if the rates are increasing, this will prop up the country's currency. $1 Million Futures Insights. Yes, seasonal tendencies. Now, some of you folks have already been introduced to this graph. This is the British pound seasonal tendency. This is a chart that I've held dear to me for many years, since 1995. I got this from Larry Williams' course, and it was among other seasonal tendencies, but because I've grown to trade the British pound more than any other pair, this seasonal tendency chart is kind of like, because it gives you like a macro roadmap of what should transpire. Now, one of the most impressive concepts you can learn is the nature of seasonal tendencies in the marketplace. The commodity market is one such market that has a very cyclical seasonal tendencies that have an uncanny ability to forecast major price swings. Now, I have used seasonal tendencies for nearly 20 years and they still amaze me. One such seasonal tendency is the British pound to make a major low in February to March, June, September, October, and December, and major highs in April to May. This is also seen in stocks as well. Let's look at the comparison of the British pound, and since we've already learned that the interest rate market is what more or less pushes the markets all around, we're going to look at the U.S. Treasuries. Yes, it does have a seasonal tendency. Now, I want to draw your attention to the fact that usually in April and May, if you look at the British pound chart on the left, you can see that there's a red line and a blue line, okay? And what that is it's measuring the bullish years and the bearish years together to get a composite index. And the blue line is a 25-year historical data, and the red line is a 15-year historical data. So you can see overall, basically, the seasonal tendency is pretty solid. It usually makes a rally of some kind late February, early March, and it trades up into the April-May time period where it makes a significant high and then trades down into the June time frame. Well, if the bonds are inverse, okay, in other words, as currencies go down, the bond market or the futures market will go up. And while the bonds go up, the yield is inverted. So the yield would be going down while the bond goes up. And for instance, let's look at the April-May time period on the bond. And you can see that it has seasonal tendency to rally. That would indicate that interest rates would be going down. Okay. Now, if interest rates are going down, that would drive what? Currencies lower. There won't be any demand. So what will they be doing? It'll be a flight to quality. That will rally the dollar. Okay? And that would be essentially a risk-off scenario. Now look at January and February. Okay? In the bond market, we see that the bonds are sliding down into that April-May time period. That means that interest rates would be increasing. Now, if interest rates are increasing, that's going to have demand for foreign currency, and it'll be a risk-on scenario. The dollar index will be falling at that time period. Okay, look at January, February time period, and you can see where in the 15-year basis it was making lows, and even in the 25-year basis it was making lows where it did rally up. And essentially around the March time period, it got in sync and made its low, and then it'll trade up into that spring time period, making a high. So study these charts, and you can see that there's a huge advantage of having insight like this, because it can put you on track to finding a long-term trend and just waiting for interest rates to get in sync with this. COT and commercial trends. Tracking the smart money. Okay, guys, you've probably seen this a few times in some of my other tutorials, but mainly you want to be looking at higher time frame charts, and you want to spend some time analyzing the net positions of the large commercial traders. You want to be looking at the trend of where their net positions are moving. Are they continuously moving higher, lower, overall bearish or bullish? In other words, are they swinging bullish above the baseline 0 line, okay, during uptrends, or are they doing that during downtrends? Okay, in other words, you want to be looking at the higher time frame weekly chart and determine if the price is going higher, and if it is, you want to be waiting for the commercials to be net long or extremely lightening up on their net short positions, because that would equate to a bullish scenario. The trend on the weekly chart and the swings from net long to net short are very easy to spot and determine the long to intermediate term trends or direction. Looking for trades in this trend or directional bias will further increase your odds of capturing trades with large institutional sponsorship behind the moves. Trading the news. All right, I basically look at trading the news or news releases as volatility injections. Okay, um, I don't fear news, but I certainly respect it. There are certain reports and events that I more or less will step outside of and won't trade. But one of the most difficult ways to trade the markets is to try to trade the news releases themselves. The internet is littered with so-called robots or programs designed to quickly give you trading profits on the knee-jerk reactions to the news. To me, this is pure and simple gambling. We can never know for sure what the numbers will be in the reports, and to guess is just ridiculous. However, we can wait for the release and watch the reaction, and many times a signal will form shortly after the release, many times counter direction to the intended news hawks. Use news releases for injections in volatility and fuel trade ideas based on price action. Key market moving indicators. Key economic releases. Okay, we're going to be looking at the US market, the UK market, and the German market. Okay, we're going to start with the UK. The British pound. Daily rate decision, retail sales, consumer prices, claimant count, GDP, and industrial production. Those are reports that I have on my calendar, times when they're going to come out, and I will absolutely be aware of these, and I will be more or less looking for trades to either be propelled in the direction that I've been prior to the report, or I'll be looking for a signal to generate shortly after one of these reports are released. All right, the US dollar, we're going to look at the North American market. Federal Reserve rates, retail sales, consumer and producer prices, non-farm payroll. I avoid that. I do not touch it. Gross domestic product, GDP, trade balance, consumer confidence reports, and service and manufacturing, ISM. You want to note these as well because all of your crosses with the dollar will be impacted by this as well. Okay, the German market. We're going to look at the euros. Okay, rate decision, German IFO, German unemployment, German consumer prices, German GDP, and manufacturing and services sector, PMI. You want to have these on your calendar when time they're going to be released, and be aware of these because these absolutely will move the market considerably. All right, plan for news impact. You have to have an awareness of your economic calendar, folks. Now, there are a few resources that you can use to determine when high impact news will release and hit the market. Number one, obviously, babypips.com's calendar, forexfactory.com calendar, and you can actually Google Econoday calendars. You can find some at Bloomberg and a few other resources, but they have a very good format. I like that. They're very user-friendly. Now, for more information on this topic, and if you have any more interest on interest rates, I would recommend that Chris Lorry's Inside the Banks webinar. I purchased this a number of years ago, and I was very impressed with his presentation on the banking level in terms of interest rates and how they move and propel the marketplace. So if this doesn't more or less get to the understanding that you're looking for, I would counsel you to do a little investment in your career. And it's not much money at all, but it absolutely is a wonderful resource. He does a really good job in that webinar. You can reach Chris Lorry at chrislorry.com, and you can get his webinar from his website. He's absolutely the only one that I recommend any folks buy material from. I have everything but his Aussie yen course, and I just don't trade yen crosses otherwise. I probably would have bought that as well. He does a really good job of teaching. He's very very interested in your success, and that separates him as far as my concern. from all the other folks out there. So, kudos to him. All right, guys, 30-year treasuries and T-notes. Okay, now some of my best concepts are found in my early days as a futures trader, and the bond market is a big market, and it provides so much insight and leading information. Now, I don't trade bonds anymore, but I absolutely monitor the futures on a daily basis. This market can tell you everything you need to know in any market asset class if you understand it. The scope of the bond market is not the objective here, but we will use it to discover some rather impressive techniques to ferret out some blockbuster trades. 10-year treasury notes. Okay, much like the 30-year treasury bond, I used these early on in my career as a futures trader, and there's a little caveat to understanding the bond market. Whenever you see the price chart on the futures, when they rally up, they will have inverse relationship. In other words, as the price data goes higher, the yield will actually be going down. So you have to have that in your mind. Now, since I trade the cable and the fiber exclusively, I trade tracking the German 10-year bond as well. The 5-year treasury note, much like the 10-year and 30-year, and when the price runs up on the contract price on the futures market, the yield will be basically decreasing or dropping. And obviously, if the chart would be dropping on the futures, that would mean the yield would be increasing as well. And much like the 10-year, I also track the 5-year German bond as well. And 2-year treasury note, much like the 5-year and 10-year, I track that on the German basis as well. And by having an understanding of all three of those, we can find some pretty neat things we're going to learn about here shortly. Obviously, it goes without saying the US dollar index. I like dailyfx.com. If you go to the NetDania charting, now do not go to netdania.com. Okay, it's very important. Go to dailyfx.com and use the NetDania charting. It's free. Okay, and just open up a US dollar index chart, and it'll give you, what I like to see in terms of the US dollar index. I look at the cash basis also, and the chart to the right here. This is the futures chart of the United States dollar index. If you like these types of charts and you want to subscribe to them, it's not very expensive. All things like $25 a month, but you can get that at pricecharts.com. You don't need to pay for futures charts, but I do prefer this format because I'm used to reading them since 1990s. I've just grown accustomed to having them in my repertoire. Now, I like to use SMT concepts to spot diverging highs and lows between the USDX and relative price points in the fiber and cable. And you know that as my USDX SMT, and I look for the bond and USDX SMT as well. Major stock market indices. Okay, the major stock market indices are one of my favorite tools to gauge long-term price swings. If we are failing at highs on the daily charts, as we see here in the image to the right, this suggests a possible risk-off scenario. Expect weaker stock prices and possibly foreign currencies. The US dollar index will confirm this with a rally at support at the same juncture. Simply reverse for risk-on scenarios. The markets as a whole are interconnected, and it pays to monitor them and hunt for clues. The CRB Commodity Index. Okay, now I usually watch this on the cash basis, and you can get that from the pricecharts.com. I'm sure if you do a Google, you probably find it as well. But again, I just really like this chart. I think it's real crisp, and when you print them out, There's nothing like printing out charts and marking them up by hand. I'm like a Flintstone caveman. I like being able to carve up, some notes and draw over my charts. I like sharing with you guys electronically, but if it's going to be a matter of preference, I would love to have printed charts every single day. This is my opinion, really. Now, I like the CRB index because it usually has a inverse relationship to the dollar index, and I like to confirm a swing higher in the dollar with shorting fiber and or cable with a CRB decline. Now the CRB index tends to be a little bit early and can warn of possible long-term shifts in the trend. It's a dynamite tool to use for major market analysis and pinning down long to intermediate term directional bias. All right, oil and gold. Now I like looking at these two markets. I don't trade them, but I'd like to use them as barometers more or less to see if there's risk on or risk off scenarios underway, and basically you want to be looking at the same way that foreign currencies and CRB, all of those markets should be moving in tandem with both. Okay, we're looking at the T-note yields. Okay, these are going to be the 2-year, 5-year, and 10-year, and you can look at the legend up here to determine which is which as we go through. And what I'm highlighting here is when there is a divergence between these yields. Okay, these are T-note yields, and this line is not the T-note price, it's the actual T-note yield. So the yield is actually an inversion of the futures charts price of the T-note. Okay, so I kind of monitor both, but the yield, when you monitor it like this, it will basically mirror what foreign currencies should be doing. In other words, as the yields were increasing here, that would have been bullish for foreign currency, and contrary, as the yields drop, that would be bearish for foreign currencies. Okay, you see these confirmations in your technicals on your charts. In other words, if there's a buy signal for foreign currencies in your daily charts or respective time frames that you trade, and there is a sell signal being confirmed in the US dollar, that is a confirmation that you probably got a good probability of a nice swing for your respective time frame. Now, what we're referring to here is a daily basis. So this is really going to give you a buy program or sell program. Okay, this is the beginnings of a buy program. This is the termination of a buy program and a beginning of a sell program. Now, the main thing as I want you to focus on is that there's typically a 3 or 4 month cycle. Okay, it's like almost like a quarterly effect that takes place in the yields, and it's based basically on interest rates and macroeconomics and things of that nature. But I'm not going to bore you with that here. But just basically, if you look at the charts and on a historical perspective, you'll see that that is in fact what happens on the average. Now, what we're going to do is we're going to talk about at the time of this recording, this is June 2012, and what I'm looking at is trying to go over why we saw the precipitous slide in the foreign currency market, namely the British pound and the Euro USD pairs, cable and fiber. And we're going to look at how that relates to these yields here. Okay, and what we're looking at again on this chart is the United States 10-year, United States 5-year, and the United States 2-year T-notes. Okay, and again, these are the yields. And basically what you're looking for is at specific times seasonally and quarterly, there will be a divergence that posts in these yields. And that looks like this. We have, it may be a little difficult to see, I understand, but the orange line here, which is the 2-year, the high made back here is lower than the high it made in March-April time period, okay, or actually in March 19th. The high here on the 10-year was just about equal, and same thing here, we have the 5-year just about equal. Okay, so we have a divergence between the 2-year, 5-year, and 10-year. Okay, that typically is a reason to start looking for other reasons to support a decline in yields, which would represent a decline in foreign currency and a rally in the US dollar index. Okay, so let's take a look at a few other examples, and we'll look at the foreign bond markets. All right, now we're looking at the 5-year notes on the UK UK's 5-year note, the German 5-year note, and against the United States 5-year Treasury note. Okay, and we're going to look at this same time frame in here. Okay, going back to this chart real quick, just to reference again. We're looking at 2012 March, April time period. Okay, we're going to go and look at this area here, and what I want to draw your attention to is the fact that we had the US 5-year note higher respectively, while the German 5-year note was lower, and the UK 5-year note was lower. Okay, and what I'm going to do is I'm going to take off the UK, so you can see there is a clear divergence between the US and the German. That'll sufficiently show the divergence. Okay, you can see the high here. It's a high on the red line. That's the German 5-year note. It's bearish, while at the same time the US 5-year note was making a higher high in yield. Okay, and then you saw them slide together. That is a yield SMT divergence. Okay, as I look at it, you can see a contrary signal here back in October of 2010, where the German 5-year note was failing to make lower lows in the yield. At the same time, the US 5-year note was making a lower low. Okay, and then we saw both yields increase together. And here the high, you saw an inability for the US to trade higher in yield, while the German yield went higher. And you can see there was the shift in the major market sentiment. And that's really what this is measuring, market sentiment, because you're chasing the yield, okay, and the market's always going to seek yield. Okay, so if the yields are increasing, that's going to be bullish for major currencies, and it's going to be bearish for the dollar, and vice versa. And we've seen the same thing here in this April of 2010. Okay, the US 5-year made higher highs, while the German 5-year note was unable to make equivalent new highs. And there was your shift. And notice this is happening March, April time period. And we just recently, at the time of this recording, also had another divergence, which is a continuation of this longer term downtrend in the yields. And again, here is a 10-year comparison. We're going to compare the German, which is the orange, the UK's green, and the lighter orange is the US 10-year Treasury note. You can see that same thing happening here, where the German was making higher highs, while the US and UK 10-year notes were failing to make higher highs in their yield. And the same thing is also that low that was formed in the fall of 2010. We saw the German 10-year failed to make lower lows in yield, while the US Treasury made, on its 10-year basis, made a lower yield, and the UK failed to make a lower yield also. And then that was your sentiment shift to bullish, and that would have been looking for buy programs on major currencies and sell signals, okay, in the dollar. Okay, in other words, the dollar would have been declining all during this period here, and at this point where we saw a major shift, okay, and the yield diverge, the sentiment now was going to send the dollar bullish, and then major currencies on the foreign would be declining. So that would be a risk off scenario here, or a sell program from Forex, and this is a buy program, okay, where the current foreign currency markets would be rallying, and the US dollar at this time period would be declining. Okay, so it just basically think in terms to make it real easy for yourself. When the yields are going up, the foreign currency markets should be trailing in sympathy, okay, because they're going to chase yield. And as the yields drop, foreign currencies are going to chase that down as well. There won't be any demand for that foreign currency, and there'll be a flight to safety in the form of going back to the dollar and buying bonds. Okay, so again, there's an inverse relationship between the bond market itself and the yield. As bonds would go up, the yields would drop, and vice versa. Okay, so that's basically the panoramic view of a risk on, risk off scenario and determining buys and sell programs on the daily basis. And this is one really strong, powerful way of keeping yourself in sync with the macroeconomic view. And you don't have to go through all this economic data. This is visual for you. You can see it happening. Just every 3 to 4 months, just look for a shift to occur. And when you start seeing these things occur on the yield, okay, that's when you want to be looking at your price charts and looking for maybe some top formations and some reversal scenarios. Okay, and same thing in here. So we're using seasonal tendencies, cyclical analysis, and the yield analysis, where the market will always seek yield, and if yields are dropping, that's going to be bearish for major currencies and bullish for the US dollar. Key support and resistance. You got to know your key levels, guys. If you don't have a firm grasp on support and resistance, all this is going to be a waste of time, because none of your signals are ever going to confirm entry or exit unless they get to one of these key levels. The cornerstone to your success in trading will be your patience in determining high time frame key support and resistance levels and waiting for the setups to form at those same levels. Once you have directional bias based on the major market analysis, you identify key price levels from the 60-minute chart up to the monthly, nothing less than a 60-minute chart, and ideally the daily basis is optimal. Determine monthly, weekly, previous days, session highs and lows, as well as pivot levels and Asian range highs and lows. Market sentiment. You're going to have to avoid the herd mentality. If everybody's doing it, it's probably not a good thing in the futures market or Forex. It's usually probably petered out. So you want to be looking to trade against the majority. Now, when deciding to take action in the market, it is important to remain on the side of the market that is the minority. Looking for trades when the market is by all appearance bullish when you want to short is ideal. And you might have already guessed it. When it looks bearish, do your buying. This might sound rather obvious and elementary, but consider how little actually followed this mindset. Consider the intraday Judas swing, for example. This is a sentiment play by all standards, and it's used to quantify an entry in the opposite direction. Market structure. Hunt intermediate term price swings. If you find all of your trading occurring at long to intermediate term price swings, you're going to find that your trading is absolutely mind-blowing. The ideal setups for trading low risk, high probability swings is to limit your consideration to only trading the intermediate term highs for shorts and intermediate term lows for longs. Taking short-term scalps and or day trades in the same direction is advised. Your trading plan is not to capture every move in the market. just the easy, low-hanging fruit. Using daily, 4-hour, and hourly market structure and nesting fractals can be a wildly profitable price action approach. This is my core price action concepts. Open interest and premiums. Now, open interest reflects smart money activity. Now, the open interest is basically only going to be found in the futures market. And the open interest in, for instance, this example here. Okay, in this example, we're looking at the Swiss franc, and what I've noted here is that price had ran up. It's been in an uptrend, and we moved into a trading range. Okay, and if you look at the circle here, that is open interest. That cumulative line that goes along and all of a sudden drops off precipitously, drops straight down. Okay, that is open interest declining while the market is in a range. What do you think that translates to? Well, this is a concept that I adopted from Larry Williams, and it still serves me well today. The open interest, while in a market consolidation or range, can tip the hand of the smart money if you understand what to look for. If the open interest drops off 20% or more rapidly, this is attributed to commercial short covering. If open interest increases 20% or more rapidly in a consolidation, this is commercial short selling. Commercial traders are the largest hedgers in the marketplace, and when you hedge, you're essentially shorting the market. You're selling something you already have. So if open interest declines, that means that they're lightening up aggressively on their shorts. Why would they do that? Because they anticipate price going higher. When you have a premium in the futures contracts, that means the nearby contract is selling at a higher price than the next month out in the future. That is a premium. Okay, that means there's a high demand for that particular commodity or currency. If you see open interest dropping off in that scenario, this is a near perfect trade scenario. You need to be buying. And as a result, this was a mega trade. This is in 2010. If you look at your charts around the 4th of July in 2010, you can see how in the FX market, the pair for the Swissy fell out of bed like a rock. This trade in the futures market actually moved 2,300 points, and it did it less than half of 2 months. And the open interest dropped while in the range. It supported 118, and it was in an existing trend already. And that's an absolutely mind-boggling profit. And if you have that type of scenario unfold in the marketplace, and you see a couple of these happen a year, you can really absolutely catch some explosive price moves. So I would counsel you to look at open interest in the futures markets on the pairs that you trade. The Swiss franc is an example here, but it's not limited to that. You can use it in the dollar index. You can use it in the Canadian dollar, Australian dollar, British pound, Japanese yen, and even the euro. Higher time frame directional bias. Maintaining a focus on the weekly, daily, and possibly the 4-hour time frames will keep your trading in the highest probable direction. Look for support or resistance on these levels to determine where price is trying to reach to. If price is trading lower on the daily, look for an old low or high in the left side of your chart to determine if there is time and price available for trade given that direction. Reverse for looking for buy setups. The main point is to keep the higher time frame in your trading. It really does pay off. General market, risk on or risk off. You want to start with the interest rates. Are we seeing yields dropping or increasing? Is there weakness or strength in the stocks, commodity, and treasuries? Is gold and or oil giving you any clues? Is the dollar index confirming recent highs or lows compared to the interest rates? Are there any market reports due that might change the current market tone? The more the other asset classes confirm or negate your trade idea, the better. Risk off, dollar rallies. Risk on, it slides. It's that simple. Anticipatory stage of analysis. This is the stage of analysis where you will spend the majority of your time. It is on the weekly and daily time frames. Since the trades are based on these higher time frames, there might be a few days or so before a trade actually sets up. But don't worry, that's a good thing. You want to track the interest rates. You want to be paying attention to COT, commitment to traders reports, major market indices, seasonal tendencies, key support and resistance levels, and intermarket analysis with correlated assets. This stage of analysis is the foundation to your successful trading career. Execution stage of analysis. This is the stage of analysis where you hunt setups based on the insights and conclusions you arrived at in the anticipatory stage of analysis. If risk is on, look for setups to buy currencies and confirm these setups with higher moving or poised to rally stock indices, CRB, oil, gold, and SMT concepts. If risk is off, look for setups to sell currencies and confirm these setups with lower moving or poised to decline stock indices, the CRB index, oil, gold, and SMT concepts. Management stage of analysis. This is the stage that requires your concepts for trade management on open positions, the management of stop loss orders, limit orders, initial profit objectives, and scaling later portions. Your trading plan must have clear concepts and techniques for the process that you will adhere to when managing open positions. This stage of analysis is crucial for consistently and having longevity in this career. You can find wonderful setups, enter at optimal entry points, and still mismanage the trade. And in this stage, you will find results bring with it loss and regret if you do not manage your analysis correctly. Reactionary stage of analysis. This stage of analysis is seen where your trades are open and you suspect or clearly see reasons to collapse the trade and cut your losses or take what profits you have open. There must be clear parameters in your trading plan that will invoke an immediate trade termination and abort on your original trade idea. This might be a result of a report or news event, global catastrophe, and or you realize you're simply human and essentially wrong. Imagine that, making a mistake. The documentation stage of analysis. This stage of analysis is where you record in your journal what your trade idea was based on, what tools you used and why, screenshots and how you felt going into the trade, while the position was open and what made you nervous. The results of the trade should be documented and reflection on the trade plan and was it adhered to from the beginning to end. Document any lessons learned from the trade and what you would have liked to have done differently. Determine what leverage and or lot size your next trade will be using. Keep these records and refer to them when you experience a period of drawdown and or a string of losses. It will remind you that temporary losing streaks come and go.